The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
We have to be careful here on Talking Real Money because we have a...
That would be a divergence from the past, of course, but okay.
No, we have what is generally a relatively affluent, responsible audience that is doing pretty well financially, generally speaking.
Okay, I mean, I just want
we got to be careful,
especially comparing to the average,
right,
in America,
right,
way above that,
right. The average American, the average American is not listening to this podcast.
No,
I'm pretty much
they should be.
I'm going to tell you they're listening to Joe Rogan. That's who they're listening to.
Big time.
They're listening to Joe Rogan, and we want to talk
Robert
a little bit about. Yeah, he's got a big audience.
He does.
It shocks the heck out of me.
Because you've been saying the same silly, dumb things for 30 years. So,
Bob Kiyosaki has said, or a good example, The Ramsey Show.
Yeah.
It's another one. It's a lot of people who are not doing as well. When you listen to the calls, you'll see what we're talking about. It's like, I'm in debt up to my eyeballs. Most of his calls are, I'm in debt up to my eyeballs. And so we have to be careful to not get caught up in the great position most of our listeners are in. And remember, there is a sizable portion of this country that believes things aren't going well, that literally maybe aren't going well for them, and some studies back that up.
Yeah, and by the way, and this comes off the tail of another recording we just did about where we had a question about the book Die with Zero, where you correctly pointed out, well, that's great if you have the money and you can live this way and give it away while you're alive, but most people can't.
But if you're trying to make it to the end, you don't want to start giving it away so that you run out at 90.
It's not good. I've seen that happen as well. But I think you correctly pointed out that the average savings for people in their 60s is less than 100,000. It's some very small number. So I find this interesting because I think it leads to some things that we could think about, not just for ourselves, but for our children perhaps or others, because there's some stuff in here that people need to think about. So this comes from not a source we use very often, Yahoo Finance, but they just did a survey with Marist, and they just polled a bunch of people and asked them about how they feel about their money. And I'm going to read a little bit of it here because I think it's pretty interesting. It says a little more than halfway into 2025, Americans are facing new and complex financial challenges. While inflation has cooled, the effects are lingering, especially in light of higher tariffs, elevated interest rates, which I'd argue a little bit about that, and a tight labor market. And again, I'd argue a little bit about that because the labor market, I think, is teetering a bit. Credit card balances, and I do agree with this, credit card balances, from what I can read, have once again reached a new record high. Student loan delinquencies are climbing, and a significant number of Americans still lack emergency savings. Those things I all believe to be true. So how do you feel about money or your finances or the future? Here's some amazing key findings, Don. 45% of adults describe the cost of living in their area as not affordable or not very affordable. Half.
Yeah, wow.
Basically half are saying, I can't afford to live here.
Some of those live in like Wichita and Little Rock
apparently.
and things.
It's all over the country.
Oh, okay.
I found that shocking. But I find even more shocking that 1 in 3 Americans say their financial situation has deteriorated in the past year. Now, financial setbacks, of course, most common among lower income individuals and older generations. And by the way, you and I are both in the now older generation.
Yeah, we're way into it. Speaking of the older generations, though, I want to clear up a number. The median savings, not the average, but the median savings.
Yeah, right down the middle, yeah.
Right down the middle. The median savings for Americans over 65 is $200,000.
Okay.
Approximately $200,000.
Twice what I just said. So now I'm feeling a whole lot better.
Yeah, but 200,000 at age 65
doesn't get you very far.
Not going to give you much income in retirement.
And people that think they're going to retire and live on Social Security, well, you're going to live on it, just not live very well.
You're going to live pretty badly.
A little more than half Americans express satisfaction with their savings, while close to 1/3 report being very dissatisfied or completely dissatisfied with their current level of savings. Back to what you just said. 200,000 at age 65, while in some ways sounds better than 100,000, is not going to be sufficient for most people to provide the income they need for to pay them in addition to Social Security, which is what most people get at retirement. And it says 45% of adults report their income about matches their expenses. Now, this is an area where we've talked about many times. It's not the focus of the program, but finding little ways to reduce that expense can make a big difference over time. Most people don't do that. They live kind of to what they bring in home, right?
Right.
Or worse, they live that and
live
then they get a
above
credit card.
what they're bringing home.
Exactly.
And then they end up calling the Ramsey show.
And saying, I'm up to eyeballs in my debt.
And then he yells at you.
58% of Americans say they know their net worth, while 21% say they do not, and 21% are unsure. That's an interesting question, because if you're 35, does it matter? Should you be running that number every year? I don't know. So you're saying, I'm worth this much today?
You run it to give yourself a benchmark.
Okay.
I think you run it annually because it's so easy to run. I don't understand why
take
people
a whole lot of work.
Don't run it.
They said most people don't know how to.
I would not. Okay, people without a big net worth may be thinking, what should I include in that? Pretty much the equity in your home based on a fair market value.
Okay, let's describe that so people are clear about that.
That's what your house would actually be worth after all the costs and expenses associated with selling it.
So you go to Zillow, it's not that number. You can take about 10% off of that.
Less than that number.
Yeah.
And then subtract your mortgage amount,
those two
how
numbers
much you
come
owe.
out of it. Mm-hmm.
That goes towards your net worth.
Yeah,
Then your retirement plans at work, how much they're totally worth right now, and any other assets you have outside of your retirement accounts, brokerage account, bank account, CDs, whatever those might be.
Sure.
That's it.
All on the plus side.
And don't add in your car. It's not really an asset.
No, that's not
Don't
an
add
asset.
in stuff sitting around the house.
How
if you
about
have
my
some
pontoon
really
boat?
valuable jewelry, maybe, if you had it appraised.
My pontoon
no.
boat, should that be in there?
No, absolutely not, because that's going down someday soon. It's just
soon. Waiting for the next storm, is it?
Yeah.
But then you subtract out what you owe others. You mentioned the mortgage, for example, other debts, etc.
Oh, I forgot. If you owe stuff other than the mortgage, you got to take that out
and
too.
Many people do. That would be on the negative side. Then the number that you are left with, that is your net worth.
And the reason I want to know that is so that I don't need a actual physical chart, because if I know it year to year to year to year, I can mentally chart my progress financially toward my goal of getting to retirement with 7 figures.
Yeah, well, now I will be honest here. I used to keep it, but then when I got divorced, I quit keeping it for a while because it was
because it was too
this
depressing.
Is bad. Yeah, this is bad. And then a few years later, I started keeping it.
The moral of that story is don't get divorced.
Yeah, don't get divorced.
Kill
Stick
them
it
off.
out.
Oh, wait, no, that's not what I meant to say. Oops, sorry.
That's AI speaking. Let's go through a few of these numbers. 1 in 3 Americans say their financial situation has deteriorated in the past year. That's a fascinating thing.
Yeah.
But let me give you the generational look at that.
I bet it's younger on this one.
Older generations,
really?
39% of Gen X, 35% of baby boomers, and members of the silent greatest generation, of which that number is getting kind of small.
There's like 8 or 9 left.
I saw one the other day. Are more likely to report that their family finances have worsened in the past year than members of Gen Z and millennials. I do not understand that for the life of me, because basically if you're a baby boomer, where you are is where you are. I don't see how it could get worse. I guess you could have a health problem or something like that, but otherwise you're kind of where you are.
When does the baby boom end?
Isn't it about 1960? Yeah, about 1960.
So that means that
like that
all of us are over 65.
Yeah, you can look it up, but I think it's something like that.
No, all of us are over 65.
So I don't know how your life could really, other than a misstep of some horrible I mean, I guess here's the way it would work. If the market had been down for the last year, then you could say, yeah, my situation's deteriorated. I have less money than I had a year ago. That would
I take it back. The baby boom ran through 64. So
64.
Everybody's in their
Okay.
60s now.
Okay. But that strikes me as odd. There's a clear income gap, too. The survey says 47% of households earning under $50,000 report worsening finances compared to 27% of higher earners. That does not surprise me because at the bottom, it's generally tougher. Men twice as likely as women to report that their finances have gotten better, by the way, which is, I find that kind of interesting, too, that men are more feeling better about things than women. But that
Now,
is
the only thing
I
I can attribute some of these to is perception, not reality, not sitting down and factoring the financial reality, but perception, worry because of what's going on in the financial world.
Sure.
Because
It had been a lot of uncertainty in the last 6 months.
When you have all of this tariff talk, and then the tariffs are on, and then the tariffs are off, and then the market goes way down, and then the market goes way up, and people are worried about AI taking jobs, and so employers start laying off people because they're replacing them with AI or whatever it might be. Even if they're not really doing that, all of that perception drives these feelings. And again, this is not to sound sexist in any way, but generally speaking, because of the way they're built, women tend to worry more than men do. And so they're thinking about these things because they're concerned about the uncertainty. They want that certainty. So I think and that's also the case with older people. They want a higher degree of certainty.
Got fewer years to fix things.
I don't have time. Yeah, no, let's just make sure everything works fine. And then in 20 years it can fall apart. I'll be dead.
Preamble about sexism. I was looking at the producer's notes here.
Did you just fall into your microphone?
I was so excited about this. I was looking at the producer's notes. He says it's okay for you to be a sexist, but no more being a leftist. So I don't know what that means. But all right, what about
I'm right-handed.
savings?
No, see, look at that. I'm no
2025
lefty.
state of savings. 35% of Americans were either very or completely dissatisfied with the amount of money they'd saved over the past year. That doesn't. I'm
whose fault is that?
Well, but I wish I'd saved more over the last year. Did you save as much over the last year? I was always
over the last year. I saved more over the last year than I expected to save. Yes.
You did save more over the last year than
Yes.
I did not. I had a goal for the year, and I'm not going to hit it for 2025
I saved more over the year than I thought I would.
I spent way more.
For the first time in my life.
Good for you. I mean, I spent way more, as you know, on fixing my place.
The only reason I saved more than I expected was because I unexpectedly went ahead and filed for Social Security.
Well, that's true. People are still, everybody I bring that, they're like, well, Don did it. I go, yeah, these idiosyncratic reasons for
I have weird reasons. It was all weird. I'm saying it wasn't financially based.
Yeah. All right.
It was just me being me.
Yeah. Okay.
Being human.
I'm glad you said that because it's going to come up in the next meeting. Well, Don's doing. Yes, I know. Don's
well,
doing
okay. Bear in mind, folks, I'm like 8 months from the max anyway, so I only took it a few months early.
Okay. You waited.
Most. I did wait until 16.
And just very quickly to close this out, our survey found that older respondents are less satisfied with their savings. Well, again, that doesn't surprise me because if you're, as you said, if you get older, you got less chance to save for the future. I mean, you got to kind of have it done.
Exactly. If you're smart, you're going to be less satisfied because you should have it invested in such a way that you're probably earning less than you have in the past.
Bingo.
That's the way. Yeah. But that's as it should be.
I think that's
Are you
right.
done? Is that all?
No, I'm not done. I have a question for you.
Okay.
So
is this from the survey?
Professor? No, this is from me.
Oh, from you.
So what do we do about this? If you're one of the 1 in 3 that says, "Wait a minute, I'm not going the right direction financially," how do you fix that? How do you do better? Or if you have a child or grandchild, you feel that way, like their life isn't as good as it was a year ago in terms of money. What do you do?
Well,
I've got some ideas. What I'm asking you.
You can't change the child or grandchild, but you can change you. If you're not satisfied with the amount you're saving.
No, I'm talking about if you're just not. If you feel like the last year, you feel your situation's gotten worse, how do you fix it? Not just savings, but the whole thing.
What are we fixing?
Fixing your financial
fixing
situation.
The perception? No, because you see, you said they feel their situation is worse.
Well, that's what the survey
I
said.
can't fix your feelings. You can fix your feelings, but it's
singing
hard.
a song, you could.
Okay, I'm just going to listen to music for the rest of the show because I'll feel better.
You're right. No, but they say there's let's make sure we're accurate about this. 1 in 3 Americans say their financial situation has deteriorated in the past year.
Again, I don't know.
Okay. All right. Okay,
I think
you're
it's
bailing. I've got some ideas. That's fine.
think it's feelings. Okay, save more.
I think here's the first thing.
I don't know. What is the answer?
I think financial literacy is the first thing because I think until you know. In other words,
as we said, calculate your dang net worth and find out, I have more than I thought.
But before you do that, you need to know some very simple. Remember, we talked about the financial literacy test that's administered by the folks at Stanford? Like, what is interest? What is inflation? What is diversification? You've got, everybody needs, and it's less than half of Americans know those things. You got to know those things.
That's sad.
It is. But that would be, to me, the starting place, because from there you'd find out what you know and you don't know. Number two, then you can figure out, I really should learn how interest works. I really should understand how inflation versus interest works. I really should understand what basic diversification, is it safer? I think the question is like, safer to own one great company or own 5,000 companies?
All right.
Yeah. Okay.
I'm just
that
letting
would be
you
one.
go because.
Okay.
Because
number two.
Okay, I'll tell you why later. Go ahead.
Number two, and this I think is way overlooked, and we've said it in previous, but paying yourself first. Remember we talked about people have a tendency to spend every dime they get.
Give yourself a job.
The first paycheck issued should be that part that you're unhappy about saving, whether it's in your retirement plan, whatever it is, and it should be automatic and disciplined.
Okay, wait. Yes. I just said that.
Okay. Then I
Didn't
will
I
give you
say
credit.
save more? And you went, no, not that. It's this. Which you just said was
financial
save
literacy
more.
First. Okay. And then the third one is, and you alluded to this, so I'll give you some credit.
You won't.
Is the benchmarking. A snapshot, I think, every 6 months or year, more than enough. In other words, where am I? How am I working my way to those goals? That's fair.
So you poo-pooed my answer, and those were yours?
Well, let's hear yours.
That's the best you could come up with? I'm telling you there's no solution.
None. So just lay down and
because
cry.
I believe that the reason they're saying it is more perception than reality.
You're right. We didn't get in and look at their checkbooks. We didn't check their retirement savings.
You can say, I'm worse off. But is it
Horrible.
really, are you really worse off? Or do you just feel worse off? And I think that, my friend, is the question.
And so, to you, the correct answer is save a little extra, hire a therapist, get together every couple weeks, and figure out how to talk your way through it.
Yep. Get yourself both a therapist and a financial advisor who will act as your financial therapist. Actually, that's the best advice of all.
That actually is.
Because then if you have a financial advisor, they can tell you if your worries are legit or not.
Yeah, well, that's true. You really should be worried. You're one of the one out of the three. You
have a real problem. Yeah.
Oh, God. You thought this is not perception. This is reality now. All right. Let's get a couple questions. I'm feeling bad now. Robert from Burlington, Connecticut. Hi, Don and Tom. Relatively new listener. Appreciate your candid takes on annuities. In mid-2023, I bought a 10-year qualified fixed index annuity. Now worth about $500,000. Funds rolled over from a target date funds bond allocation to my 401k after a rough time for bonds. The pitch? Equity upside, bond-like safety. So far, it's done well. Up 12% 1 year, plus 8% in year 2. The annuity represents part of our safe money. Total retirement portfolio is about $6 million. 60-40, kind of goes through the funds. No traditional bond funds. In other words, it's all stocks other than the $500,000 in the annuity. Mm-hmm. Instead, we hold. No. I misread that. Hold 40% in money markets and CD ladders. The annuity sits within this 40%. Okay, but we don't need to touch it. He goes through the snapshot about his situation, but I think the important part and the question is from Robert: should I withdraw the 10% penalty-free annual amount for spending or reinvest those withdrawals like buying bond funds? Those are two different things. You can take the 10% out penalty free. I would do that anyway because I don't want to be in that annuity.
Right. Because the annuity has, for example, you said you got that 12% 1 year, 8% the next. So my guess is 12% was for 2023.
Sounds right.
And the 8% was for 2024.
Makes sense. Yeah.
And the actual return for the total U.S. market, the total world market for 2023 was 22%.
So that sounds about right. Yeah.
So you left a little 10%. Little less than half on the table. Mm-hmm. Same thing with 2024 when the return was 16%. That's where the caps and participation rates come in. Now, in 2022, if you'd had it, you would not have lost anything.
Correct.
Where it would have been down 18. But the reality is, though, in 2021, you would have gotten about 9 when the market got 18.
We get the point.
You would have made more money if you were properly invested.
Okay, but I'm more concerned that he believes this is a substitute for bonds. We've heard this before, that these index annuities.
That's how they're sold.
That's how they're sold. I think it's a crummy comparison, U.S. government bonds versus an insurance product that is designed to get you, market-like returns. Doesn't sound like
sort
it.
Of similar. Yeah.
It just it makes everything confusing. So I'd take the 10% penalty free each year, and he's asking where to move it to. Well, you can't just move it right into Roth because that would be a distribution, and then you'd have to pay tax on it and put it in the Roth. It'd be like a conversion. So,
and bear in mind, there's also a little lie that is perpetrated by the insurance industry when it comes to annuities, that they somehow have a big tax advantage.
You already have that.
Well, no, yeah,
it's qualified money.
But if your money is non-qualified, and let's just use qualified money, you get the exact same benefit. It grows tax deferred. Then when you take it out, you pay taxes as income. You don't get a double one. But here's the beauty: if you are looking at money out, and this is for people who have an annuity outside of a retirement plan, if you invest in ETFs, for example, and they grow in value over the next 10 years, except for dividends, you will not pay any taxes on that growth of the value until you sell the ETF.
Correct.
And then when you sell the ETF, your tax will be at the capital gains rate, which currently is far lower than the income rate, whereas if you get money out of your annuity, you're going to pay taxes at your income rate.
Can I add one more thing here?
What? Yes.
Well, yeah, Robert, you're a great candidate to actually talk to an advisor. There's a lot of moving parts here. I didn't go into all of them, and this is somewhat confusing, so I think you should.
Well, and that's another example of as you get near your decumulation phase, as you're nearing the end of your accumulation phase where you're building wealth, that's when it starts to become really important that you get some help. Building it is not nearly as hard as knowing how to allocate it, grow it for your needs, generate income, and protect it down the road.
I think that's fair. Randall writes us from Jackson, Missouri. Just wanted to follow up about a question I sent last week regarding my annuity. My experience was straightforward. I had a monthly income goal, and the rep sent me 3 options, which I reviewed and made my choice. Everything by contract with no hypothetical numbers. I had a hard time figuring out why you were so dead set against them. Then, this week, I made some inquiries about long-term care and ran into a guy who came in firing both barrels with his fixed income annuity as the answer to LTC. Of course, he led with the bonus, followed by several back-tested unicorn-chasing butterflies indexes. I like that, unicorn-chasing butterfly. The cost was $2.5, what I was considering spending, and it showed that I could have $1 million when all was said and done. Fortunately, I knew enough just to move on. After dealing with this character, I now have a better understanding of your disdain for the annuity industry. So he's backing you up, Don.
Yeah, and as for your fixed annuity, that's one of the areas where we say, as long as they're giving you reasonable projections, which on the fixed annuity apparently they did, all we're saying is that when they say you can get 5.5 or maybe 6%, if you're getting 6+ on a fixed annuity, then you're probably dealing with an insurance company that's not as solid as it should be.
Might not get your money back, is what you're saying.
Right. There's a difference between government bonds and insurance that you were mentioning earlier. That government bonds have the full faith and credit of the U.S. CDs, full faith and credit of the U.S. You can get upper 4s, 5s on those kinds of absolutely safe. You might get 5.5 or 6 on an annuity because no matter what they say with their mouth, the guarantee is not as robust. They guarantee it, but that's the company guaranteeing it.
Yeah, and that's it. One final question comes from Ackworth, Georgia, part of our bustling number of people listening in Georgia. Thank you for all that. Hi, Don and Tom. Been a regular listener to Talking Real Money for a couple of years. Wanted to say thank you for consistently delivering thoughtful, informative, and entertaining financial content. Your show has been a go-to source for practical advice. I truly appreciate your candid and evidence-based approach to investing. That said...
Oh, no, there's a but. I hate buts.
There is, yep. I wanted to offer some feedback on a recent episode where Rick Edelman and his views on blockchain and tokenization were mentioned. Now, I'm going to first say tokenization to me in college, whole different completely thing. But while I understand there may be some differing opinions on the future of digital assets, I felt the tone toward Rick came across as a bit dismissive, perhaps even unkind. Rick Edelman has been a respected voice in personal finance for decades, and while not everyone may agree with his current enthusiasm for blockchain, tokenization, Bitcoin, etc., he's made significant contributions to investor education. His work with the Digital Assets Council of Financial Professionals and efforts to bring clarity to an evolving and complex space are worth noting. Rather than a one-way critique, I think it would be incredibly valuable and enjoyable to hear a respectful and open discussion. How about inviting Rick onto the show for a dialogue about the future of digital assets, tokenization, and blockchain technology? It would be a great opportunity to explore the topic from both sides and allow listeners to form a more well-rounded view. Thank you for all you do cutting through the noise and making smarter decisions. Looking forward to many more issues. Warm regards, John. Says, P.S. I don't know Rick.
No, I didn't think you knew Rick, John.
No. Well,
and by the way, if you check the record going back decades, I used to say good things about Rick Edelman. I liked his show. I thought his advice was good. He's, by the way, he was a big fan of evidence-based investing.
The was
Big
is what
fan.
The point here. Yes.
Right, and you said it in your note. You used past tense, and it's like we talk about the market. The market isn't currently up. It was up. Rick's advice was good. It is no longer good.
Yeah, and beyond,
Rick sold his firm, and what he's doing now is either one of two things. Either he lost his mind somewhere along the way, or he's just pandering for publicity.
Oh, by the way, if Rick is listening or anybody of his people, we'll be glad. We'll have him on the show. I'll have Rick on the show tomorrow, right?
Would you?
Yeah, of course. Yeah.
We don't have very many guests, though.
Here's the problem with Rick, okay? And this, I don't know, I guess I'll just say it. I feel like with him, it always has to be the next new big thing like now, rather than, because you and I are boring. We've had the same message for 30 years. It has not changed.
There is no next big thing for us.
For him, yeah, for him. And by the way, there's another one outside of the digital currencies. He also runs around the world telling us all advisors that we need to plan for people living longer. Yeah, okay. I mean, I think our software goes to 94 years or something. But he recently said if you are alive in 2030, which is less than 5 years now.
2030, that's 4 years, 4.5 years away.
You will probably live to be 100 years of age or beyond. Now, this is the kind of thing, it's sensational, but it's not very accurate. Life expectancy in the United States has actually gone down for the last 5 years. Now, some of that is obviously due to COVID, but I'm going to say, well, what's the next COVID? What's the next thing that could reduce life expectancy as well? So to sort of say blanketly, well, everybody's going to live, again, this is what I'm talking about, though. He's in search of a big headline, which I don't think is really helpful to you, an investor. So while I agree with you, yes, much of the work he's done has been good. I used to listen to the radio show.
All the time. I did too, all the time.
I enjoyed it.
I did too, except when he said Rice Delman. But that's just corny like you. I just chalked it up to him being like Tom.
Corny like Tom. But I don't like the fact that, and I bet if he's around long enough in 5 years, there'll be something new, something else. It is now tokenization, which I guess.
Right, and here, let's go to that for a minute, shall we?
Yeah.
Because remember, I said Rick Edelman was a huge proponent of the efficient market theory and of evidence-based investing. There is no one alive today who is a bigger advocate and really the father of a lot of these theories than the Nobel Prize-winning economist and professor, Dr. Eugene Fama. Okay? Rick followed Fama's principles. He did. He said so. Well, if he believed in what Fama has to say, then that makes his support of Bitcoin a 180-degree turn for him, because Eugene Fama has said of Bitcoin and cryptocurrencies, quote, cryptocurrencies are such a puzzle because they violate all the rules of a medium of exchange. They don't have a stable real value. That kind of medium of exchange is not supposed to survive. And then he went on to say, he says, if Bitcoin doesn't, he said, I'm hoping it'll bust. But if it doesn't, then you have to start all over with all monetary theories. So the whole world of what we've known, if Bitcoin survives and thrives, then everything we know has been wrong.
About trading currency,
about the economy.
Trading anything. Right.
Yeah, about money in the economy.
Mm-hmm. So, but again, I'm sorry to be unkind about Rick. I don't like the fact that, again, that it's something new, that it's something sensational, and I think it takes people's eyes off the ball, which is really, at the end of the day, saving and investing for the long term. If most people did that, they wouldn't have to worry about these other issues.
And by the way, Rick knows he's a public figure. And public figures are supposed to be criticized.
Okay.
They are.
So go to Apple Reviews.
Yeah, because we get it. We get it.
I know.
We get it all the time. And you know what? It is okay. I am good with it. I read them. Like, oh, here, let me do this. You want a recent review?
I haven't read very many recently.
Oh, you're going to love this one. Let's do this one. Listening to these two veteran podcasters, by the way, what do you think they're mad at us about, Tom?
God, let me guess.
You want to guess?
It's either politics.
No.
Cryptocurrency.
There you go. Okay.
Yeah. Okay.
Listening to these two veteran broadcasters see, that's how
Very
veteran
much.
I am. I can't speak anymore. Dismiss Bitcoin as little more than tulip mania or Beanie Babies shows just how out of step they are with today's financial landscape. By the way.
That
was yours.
Okay.
Their critique leans on decades-old analogies. Back to Eugene Fama's point, without acknowledging the evolution of Bitcoin from an experimental digital token into a globally recognized store of value, heads against inflation and growing settlement network. To brush it off as gambling while institutions like BlackRock, Fidelity, and major governments are integrating Bitcoin into investment vehicles and reserve discussions, ignores the weight of adoption and the legitimacy it now carries. Dismissing it outright sounds less like caution and more like a refusal to engage with how the financial world has shifted.
Wow. Yeah, and by the way, why are those financial institutions integrating it?
Demand.
Profits? I don't think they're doing it after careful research and saying, well, this is really a good... Anyway, we could get into that. But
so we criticize Rick.
Sure.
You criticize us fairly.
Yeah.
Wrongly, but fairly. Oh, we got a political one because we talked about the BLS director being fired for political reasons.
Yes, I know.
But whoever this is believes it was that she was incompetent. Jeez.
Anyway, letting it go. So thank you. No, thank you for sending that. And we thought about it and we disagree with you.
Right.
How about that? Is that fair?
Right.
Yeah.
We thought about it and we disagree.
And if you want to send your comments in to us, go to talkingrealmoney.com, click on Contact Us. You can type them in. You can you can speak them in. Don
you can call them in on Saturdays.
Yeah, I was getting to get to that. But we'll do the live show. You could take part in that too.
Okay. Yeah, so call us on Saturdays, 855-935-TALK, between 3 and 5 p.m. Eastern. Thanks so much for being a part of the podcast. And we're glad you listened, whether you agree with us or not, because along the way, pretty much every day, it's about talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.